Ladies and gentlemen, welcome to Hang Seng Bank's interim results announcement. On the floor with me are our Executive Director and Chief Executive, Ms. Diana Sessa, Executive Director and Chief Financial Officer, Ms. Sei-Pin So, Chief Risk and Compliance Officer, Ms. Kathy Zhang. Now I hand over to Diana and Sei-Pin to start the presentation. Diana, please.
Thank you, Kenneth. Good afternoon, everyone. Thank you for joining our 2024 interim results announcement. I will begin with an overview of our first half performance before handing over to Sei-Pin, who will take you through our financial results. In a challenging macroeconomic environment, we have shown resilience and our growth momentum has been maintained. Year on year, our profit before tax increased by 3% to 11,307 million Hong Kong dollars, and return on shareholders' equity reached 12.4%. Earnings per share increased by 1%. We see solid underlying growth in our business. Net interest income increased by 2%. As part of our strategy to diversify income streams, non-interest income increased by 4% year on year. I'm pleased to report that fee income for retail investment funds increased by 20%, and insurance service results was up 16%, 16. With our enhanced capabilities, new-to-bank affluent customer base grew 147% year on year. The number of new private banking accounts increased by 15%, and new account openings for mainland customers grew by 166%. Over the long term, we are very confident on the outlook for Hong Kong, including the property market. We remain supportive of the commercial real estate sector, which has gone through many cycles and proven to be resilient over many years. Cash flow pressures for some of our Hong Kong CRE borrowers have increased with the rise in interest rates. Our non-performing loans ratio increased to 5.32%. However, collateral levels remain very strong, with 2/3 of the portfolio secured by collaterals, and we have not seen a material impact on our financial performance. Our expected credit losses charges reduced by 22% year on year amidst a continuing reduction in our mainland China commercial real estate exposure. We anticipate that cash flow pressures will recede as interest rates reduce and economic growth picks up. Our approach continues to prepare us for the future whilst enabling us to support our customers during challenging times. Our main focus, as always, is on supporting our customers. There are a number of breakthroughs in the first half worth highlighting. Hang Seng Investment launched the Hang Seng S&P 500 Index ETF and Hang Seng Japan Topics 100 Index ETF this year. In addition to our strong product range covering the China market, Hang Seng Investment has broadened its investment coverage to encompass the world's top 3 stock markets by market capitalization, those being China, Japan, and the United States. Hang Seng Insurance now ranks number 3 in the market. Year-on-year growth in insurance new business premium was 80%. We expanded our Wealth Management Connect offerings to over 320 products to enhance cross-boundary financial services within the Greater Bay Area. We added 2 new cross-boundary wealth management centers, and sales amount of southbound investment products increased 4-fold. Hang Seng Indexes was the first offshore index compiler to incorporate Beijing Stock Exchange securities in their portfolio. With the launch of Hang Seng China A Specialized and Sophisticated 50 Index, Hang Seng Index was also the first offshore index to incorporate securities from all 3 of mainland China's stock exchanges. Our role as a bridge between international investors and the mainland market is notably strengthening. On wholesale banking, we launched the Hong Kong dollars 33 billion SME Power Up Fund, which offers diversified loan products and dedicated support to bolster Hong Kong SMEs' growth and digital transformation. We also introduced the 80 billion Sustainability Power Up Fund to provide greater sustainable financing solutions to support businesses of all sizes in their environmental initiatives. And on innovation, we continued to be a leading advocate of central bank digital currency, CBDC, in Hong Kong. We're working closely with the Hong Kong Monetary Authority on its wholesale CBDC project, including exploring use cases for tokenized deposit solutions to shape industry standard for the tokenization market. To support the expansion of cross-boundary applications for ECNY, we offer top-up services to ECNY wallets for personal banking customers in Hong Kong through the faster payment system. We have expanded our public-private partnership with Hong Kong Cyberport Management Company to launch Hong Kong's first Index Innovation Lab, which aims to accelerate SME digital transformation, green development, and nurture innovation and technology talents in Hong Kong. The directors have declared a second interim dividend of $1.20 per share. This brings the total distribution for the first half of 2024 to $2.40 per share, 9% higher than the same period last year. Our focus on delivering long-term value to our shareholders remains. Coupled with the $3 billion share buyback announced in the second quarter this year, the total capital returns to shareholders amounts to 7.6 billion Hong Kong dollars, up 80% year on year. Say-Pin, please.
Thank you, Diana. We continue our growth trajectory in first half of 2024. In the context of elevated interest rates, net interest income was up 2% to 15,483 year on year, and net interest margin increased 20 basis points to 2.29%. Our balance sheet remains healthy. Compared to 31st December 2023, gross loan balances decreased slightly by 1% amid subdued credit activities under the prolonged high interest rate environment. Customer deposits increased by 2%, mainly driven by growth in term deposit. Net fee income declined by 4% to Hong Kong dollars 2,564 million due to lower loan-related fees as a result of subdued loan demand and higher credit card fees expenses incurred as we invested in the card rewards programs. However, this was partially offset by our strong performance in retail investment funds, which grew by 20% year on year as a result of the launch of new capabilities to drive rigorous need-based wealth solutions. In addition, there was a strong growth momentum in other non-interest income, mainly driven by a 14% increase in foreign exchange revenue generated from customer activities, as well as an improvement of 16% or Hong Kong dollar 162 million in insurance services. Net operating income before change in ECL and other credit impairment charges grew by 2% to Hong Kong dollars 20,431 million. ECL and other credit impairment charges decreased by 22% to Hong Kong dollars 1,500 million due to declining ECL charges under mainland China CRE exposure. As at 30th June 2024, gross impaired loans and advances as a percentage of gross loans and advances to customer was 5.32%, compared to 2.83% at the end of last year. The Hong Kong CRE portfolio is, however, well positioned as approximately 2/3 is secured by collaterals. Collateral levels remain strong, and therefore we have not seen material impact on our financial performance. Profitability remains one of our top priorities. Profit before tax increased by 3% year on year to Hong Kong dollar 11,307 million. Attributed profit also rose by 1% to Hong Kong dollars 9,893 million. Earnings per share grew by 1% to $5.04. Return on average ordinary shareholders' equity was 12.4%, compared with 12.8% for first half for the first half and 9.8% for the second half of 2023. Return on average total assets was 1.2%, up from 1.1% for the same period last year. As of 30th June, our capital position remains strong with CET1 capital ratio at 16.6%, a Tier 1 capital ratio of 18.2%, and total capital ratio of 19.7%. The reduction in capital ratio mainly due to a total of Hong Kong dollars 11.4 billion capital return made in first half, reducing capital ratio by 1.7%. The 4% increase in risk-weighted asset resulted in approximately 70 basis point reduction in capital ratio. With self-generating capital, our 30th June 2024 CET1 ended at 16.6%. Our Hong Kong dollar 3 billion share buyback program, our liquidity coverage ratio was 262.2%, comfortably above the statutory requirement. Our Hong Kong dollars 3 billion share buyback program is on track to complete, and we will consider all options in returning surplus capital to our shareholders. Diana.
Thank you, Sei-Pin. Our strategy on growth, innovation, and sustainability is yielding tangible results. The increase in profits, return on equity, and earnings per share reflects our growth momentum. With our prudent risk management approach, robust cost control, and proactive business diversification, we have proven to be resilient and future-proof. Our solid capital position also allows us to continue supporting our customers through different economic cycles whilst creating long-term value for our shareholders. We are optimistic about the future. And on a final note, I would like to express heartfelt thanks to my colleagues for their passion and contributions as we reorient Hang Seng to meet new challenges. Their dedication ensures that we always place our customers' needs and shareholders' returns at the very heart of all our decisions and actions. I thank you all, and we can open the floor for questions.
Thank you, Diana and Sei-Pin. We will now begin our Q&A session. If you wish to ask a question, please raise your hand and we will pass you the microphone. Please also introduce yourself and your organization. First question, please. Sam from Jefferies.
Thank you, management, for the presentation. This is Sam from Jefferies. I have two questions, if I may. First is on the NPL. So NPL ratio right now is 5.3%, right? So do you think it has already peaked? And the incremental NPL downgrade is about 10% of your Hong Kong CRE book based on my rough calculation. So do you think we can still call those, isolated cases, or do you sense they're starting to have a bit of a systemic concern? And finally, how do you think about the second half provision outlook versus the first half, which is a relatively benign level?
Thank you, Sam. I understand. We understand. Of course, there would be questions on the NPL ratio. I think it would be good to understand the context of such and the shape of our portfolio. I'll ask Kathy to provide a bit more detail and elaboration on that.
Okay, thank you, Diana. Hi, Sam. So I think Diana and Sei-Pin also mentioned that the portfolio is largely secured. 2/3 of them is secured, and of which I think you can see from the presentation, on the impaired portion, the average LTV is actually below 60%. On the substandard portion, the average LTV is below 50%. So, and that's why, that's kind of explain why, why the ECL level is low. Okay, and then on the 1/3 of the unsecured portion, mainly they are Hong Kong listed company with diversified income, and also they don't have any impairments, and 90% are of investment grades, and that's also explain why we don't have a lot of ECLs. Just want to highlight that in terms of collateral coverage, ECL coverage, collateral plus ECL as a percentage of NPL for Hong Kong CRE actually is over 100%. Okay, and then for the entire book is close to 100%. Okay, so one of the reasons why the ECL is at the low level is because of the adequate collateral or very strong collateral position. So hopefully I can answer this one. And then the second one, you're asking whether it's an isolated, issue or a systemic issue. Definitely, this is an isolated issue, mainly surrounding a couple of small and medium CRE names. As I mentioned before, 1/3 of our portfolio, unsecured portfolio, actually they are Hong Kong listed company. Financial is very, very strong, and they have no sign of default. Okay. I think in terms of second half, okay, we still maintain our full year ECL is less than last year. So hopefully we can answer your questions. Thank you, Sam.
Second question, please. Helen, in the second row. Ladies in the second row.
Thanks, management. Helen from UBS. I have 2 questions. First is on capital and shareholder return. With core tier 1 capital ratio declining to 16.6%, how much room do you see for additional buyback once you complete the 3 billion one this September? And my second question is on time deposit. In the first half, funding costs increased by 24 basis points half on half, and time deposit grew by 6.8% half on half. Why did you aggressively grow time deposit when loan demand is not really there? And what's your deposit strategy going forward? And what's the NIM outlook? Thank you.
Do you want to start with the first question, Zaipin?
Right. Okay. I would like to provide a little bit more insight in terms of capital, because I think just now it was mentioned that 16.6% CET1. Do we have any more consideration for future? But let me explain a little bit on this 16.6%. If we all remember, 31st December 2023, our capital ratio is 18.1%. And just now, in my speech, I also mentioned what is happening in first half. There's a few things that's happening in first half that drive that capital ratios. First of all, we have 11.4 billion capital returns to our shareholder. How does the 11.4 billion been calculated? We have Q4 2023 dividend payout in first half that amounts to 6.1. Q1 dividend payout that amounts to 2.3 billion, and share buyback of 3 billion. So if you add up these 3 numbers, it's 11.4 billion. If you use this 11.4 billion against 31st December 2023 risk-weighted assets, your capital ratio immediately dropped by 1.7%, right? So that's point number 1. So capital returns actually of 11.4 million resulted in 1.7% drop in the CET1 ratio. Secondly, if you could see in the result that we published, our risk-weighted assets gone up, but our risk-weighted assets have gone up by 4%. That 4% roughly would result in a reduction in our capital ratio of 70 basis points only. So you try to do the maths. There's a few other elements that cause the movement in the capital ratio, like payment in AT1, coupon, and so on. But in general, with the self-generating capital that is in the first half of 2024, we end up in 16.6. So that is a few dynamic that's playing through. So please do not have the impression that the capital ratio is solely due to drop is solely due to the increase in risk-weighted assets. So that's point number 1. Point number 2, in terms of capital returns, we are on track to complete our share buyback that we announced in Q2 by September. Upon completions, obviously, as always, per our commitment to our shareholders, we will consider all options in returning surplus capital to our shareholders. I'm sorry, I think so that currently everything is on the table, right? All forms of capital returns is on the table for deliberations. If we have any decision made, appropriate announcements will be made timely.
And on your second part of the question regarding deposits, yes, I think you would have noticed amidst the very high interest rate environment, the market was extremely competitive, and pricing for time deposit actually was very pricey. We have not actually gone after the strategy of growing deposits and growing time deposit. You would have noticed over the last few years, we have been growing our customer base. Hence, our deposits deposits over time has increased, but we have not led the market in terms of deposit pricing or time deposit pricing or aggressively growing that on the back exactly of what you mentioned just now. We already have a very healthy portfolio, and our strategy and priority is to protect our margin. And that's why you see our NIM actually is sustained at a higher level than market average over the years.
Dana, if I may complement the comments that just made. If you look at the result that we published, the current account and saving accounts, the CASA ratios over total deposits is 15.1% for as for 30th June 2024. 31st December 2023 is at about 53. So the decline, while there's a lot of competition, as what Diana said, in the market in time deposits, the overall CASA ratio remain healthy, and our 51% is still above the market average of 40%. So yes, we remain committed, and we holistically look at how we deepening relationship and diversify our revenue. And some of this deposits actually is in foreign currency.
And of course, as interest rates start receding, we would expect that level of competition would be less intensified than it currently is.
Yeah, I think Helen has a question on NIM outlook. Perhaps Sabine could clarify.
Okay. I think it's quite a consensus that market expect the rates cut either 1 to 2 times or 2 times in second half of 2024. In that sense, there are a few things that we need to consider. We do hope that the reduction in rates will actually boost credit demand from our customers. And we want to support our customers through this rate cycle change as well. We'll boost economic activities that we want to also support them through the process. That says that the second point that we think that may happen is that with the rate reductions, hopefully the pace and the intensity of time deposit competition or migration of CASA to time deposit will ease somehow. That will also help in the NIM for banking industry, including ourselves. So in that sense, our guidance, which is on the screen, 2024 NIM, our NIM will be slightly lower than 2023 as how we see it.
Okay. Third question, Citi's Michael. Yeah.
Hi, thank you, management, for taking my question. This is Michael from Citi. I just want to have 2 follow-up questions, one on NIM and one on asset quality. So the first one on NIM, like you are expecting marginally lower. So how should we define like marginal? Last year, because we are 2.3, right, and first half we were 2.29, and so do we expect like a second half to be similar to first half? And how are your July NIM is tracking, because HIBOR is picking up a little bit in July.
Yeah.
And my second question is on the Hong Kong CRE. Just want to understand how much is of your Hong Kong CRE is now in substandard, and do you see risk of further downgrade, and with that do you expect more credit migration impact on your RWA in the second half? Thank you.
Perhaps Sabine can take the first question and then pass to Kathy.
Okay, thank you. You're right. First, if you look at 1 month HIBOR, for example, it went up to 5%, above 5% in Q4. And then Q1, we look at it, it went down to 4.62, and then Q2, it went further down to 4.39, and now July it go back up to about 4.6, I think. And so there is volatility in the rates movement. With rate cuts, US dollars rate cuts, that would have impact on HIBOR as well. So there are many elements that will drive the dynamics that is in the market. What our ultimate, what is important for us is we support our customer and we manage our book carefully, including NIM and everything else, among everything else. So as usual, we do not give specific guidance in terms of our profitability, but we believe that that's why we put slightly marginally lower than last year based on what we see now. It also depends on market competitions, and we do tactical solutions or we take tactical actions or initiatives in the segments that we want to expand and so on. So there is multiple angle to this margin, net interest margin outcome. So but we do not see material decline. So it's a marginal decline after balancing everything and what would happen in competition, what would when the timing of the rate cut, the magnitude of the rate cut will also have an impact. So based on today's position, still remain marginal.
I think it's also fair to say that we're into end of July already, last day of July today. So if interest rates were to start to recede in the next few months, I think you'd feel that impact more subsequently as opposed to the rest of the year. Yeah. And Kathy on Hong Kong CRE.
Okay. On the substandard book is around 12 billion Hong Kong dollar. And then in terms of whether there will be further downgrades, of course, that would be subject to a lot of different factors. Interest rate would be one. If interest rate reduce, definitely the pressure on those substandard would be much lower. And if the economy continue to recover, then, that elevates some of the, will reduce some of the pressure as well. But having said that, I just want to emphasize another point. Most of our clients, they're asset rich. Okay, currently just experience some cash flow tightening because of the interest rate. So hopefully, with the interest rate reduce, with the economy continue to recover, then we'll take off some pressure. And our LTV is quite low on the substandard. It's below 50%. So that also gives us some buffer to absorb. If there is any further decrease in property price or economic recovery is not that as if we wanted to be. Okay, so yeah. Okay. One more point is just want to highlight, just want to emphasize, our full year forecast of 2024 ECL still lower than 2023 because of the quite strong collateralized collateral
Position.
Yes. Thank you.
Okay. Thank you. Michael?
As last two questions, please. Gurpreet.
Thank you. Gurpreet from Goldman. Management, thank you for taking my question. Just two very simple questions. First is on the interest rates. So if they do decline, I'm sure our corporates are also watching. How much of a loan demand pickup are we expecting? Given that a big portion of the loan book is either residential mortgage or CRE, and then some of it is in China also. So how much loan demand do we expect? Because historically, whenever rates have been at a normal level, we can do mid-single digit loan growth. But I'm not sure if you think that if by end of next year, Fed goes to around 4%, will we return to that? Fed interest rates go to 4%, whether we'll return to mid-single digit loan growth. That's one. And second is buyback. Given that buyback was announced after the full year 23 results somewhere in April, and so this is the first actual meeting that we are having in a group setting. So wanted to get your buyback strategy publicly that you disclose as to what is it, what is the minimum level of capital that we target? Why buyback now? Because loan growth is low, maybe. Why not announce the buyback? Sorry for having too many questions on buyback. Why not announce buyback when you're doing results? Maybe something to do with regulator or the group to coordinate. So why this off-cycle buyback? And how do you see it going forward? Thank you. Okay.
Good call that we announced it in Q2 where we do half-yearly results. I think if analysts remember, we for longer time, we have not done buyback before. So this is the first time that we do buyback since a long time ago. So there is some process and procedures and proper governance that we need to go through. So that's why it ended up doing an off-cycle one, because we don't want to hold it back, for example. We don't want to hold it back until July that we make the announcements, as we commit to analysts, shareholders, that whenever we come to a conclusions, we will do a timely announcement. That is keep to our commitment to external parties that we have made. So that's point number one. Point number two is that our share buyback is on track to complete in September, based on our expectation as well. So it's within our expectation to complete in September. Diana, as Diana says, our capital positions are strong, and we still have strong self-generating capital capabilities. So every options is possible in terms of going into a forward-looking basis. But at this juncture, I think everyone could appreciate that there should be proper governance and everything else before a matter like this that can be announced. And also we have to consider all options. So we take the feedback. So I think it's a good feedback. Try not to do anything off cycle. Try to do material announcements together with result release. I think that's a good feedback. Not trying to find excuse, but that was the first time since a long time we did a share buyback, and we will take this feedback back and ensure that if possible going forward, try not to do any off cycle announcement, if any. So thanks for that. I think we take that feedback.
I think it's also, Gurpreet, thank you for your question. I think it's also fair to say that we only announce our results interim and full year. So we don't do actually quarterly results announcements. And as Sapien says, we do have a process and a regular agenda in place to review our capital position. And of course, on the basis that we would be prioritizing and focusing on return of capital to shareholders, as and when we assess that there is an opportunity to do so, we didn't want to hold back. We are in the midst of completing what we have announced earlier, the 3 billion, and we can assure you on an ongoing basis, we will continue to review that position. We were asked, if there would be another announcement of some sort. And I would say, actually, all options are on the table. It's not so much a preference of one direction over the other, it's what exactly is the right decision, and then in the best interest of our shareholders. So I hope that answers your that part of the question. You also alluded to loan growth and what to expect. I think it wouldn't be unfair to say that we don't have a crystal ball. None of us actually do. But I think it's fair to say that there will be a lot of factors affecting the loan growth and the magnitude of interest rates cuts, when they will happen, how is the market reacting to that. Of course, that will be a signal that would potentially ease. It would ease pressure, especially cash flow pressures for a number of clients, some of the clients, but it also would mean it could potentially stimulate economic growth. So I think there are two sides to the coin there. What's important is that if you notice on our results announcement, our loans growth was down -1%. I can't say we're arresting that, but because the market is still not exactly out of the woods, if you would. However, we are diversifying our business into different sectors. So if you recall, we had a rather concentrated book and very balance sheet heavy. We're now diversifying our revenue streams, that's one, and also diversifying our client portfolio into new economy sectors. So whether it be pharmaceutical, healthcare, whether it be EV, whether it be new economy, e-commerce. So I think that direction would help us fuel future growth on a more steady basis and balancing, the what comes may, if you would, in terms of the impact on rates reduction. I hope that answers your question. Yeah, thank you.
The last questions, please, Emma, please go ahead.
Emma.
Thank you for giving me the opportunity to ask the last questions. I also have two quick questions. The first one is still about the capital. So you do explain the reason to lower capital ratios in the first half, but we also noticed that there is a notable item called, there is a notable deduction to the CET1 One capital of 4.8 billion in the first half, which is due to the excess of expected credit loss over the eligible provisions. So why these items inflated a lot in the first half? Because by end of last year, it is only 0.9 million and 0.9 billion. And how should we project this item? Because it indeed have a large impact on your capital ratios. And the second one is about your loan growth. So most of your loan items indeed are contracted in the first half, but we noticed that your manufacturing book and your retail and wholesale book did achieve double-digit growth in the first half. So could we note the profile of these clients, like the yield and also the NPL ratio? What types of these clients are and are these sectors the sectors that you want to pursue the loan growth in the coming quarters? Thanks.
Okay, maybe I take the deduction one first. Okay, I think you are referring to our capital base table that we published. Yeah. So the 4.7 or 4.8 billion that you're referring to, that relate to IRB approach that is required in terms of calculations. From that, actually, it's a little bit in tandem with the NPL or credit migrations that we are talking about. However, Cathy has explained to us, and it was appearing on a chart, that it's quite well collateralized, so those part I won't dwell into it again. So arising from that, but if you notice, that one actually erode the capital positions by 56 basis points. That amount, though you think it's 4.7, but it's about 55, 56 basis points in terms of capital positions, right? So if you think of how to project that probably in tandem a little bit with credit migrations. That is, however, it's quite technical in the overall thing in terms of IRB approach. But if on a very simplistic way of looking at it, that's what it is.
And I think, Emma, your second question regarding loan growth, I didn't quite exactly get, that was a very long question, loan growth and different sectors and how that impacts our risks and credit quality. I think I've mentioned just now, in terms of loans growth, I think the first and foremost priority I'd like to call out is we continue to be supportive of our customers. We continue to support our customers through challenging times. And on that basis, we have to take appropriate actions, and we do adopt a more forward-looking, if you would, conservative, prudent view when it comes to risk management. Hence, that explains the current position. But in terms of a growth trajectory, we are going after different sectors of customers. So we're supporting current customers, but at the same time venturing into new sectors that we have not been as active as before. So as I said, healthcare and pharmaceutical, e-commerce, advanced manufacturing, clean energy, these are areas that we are actually venturing into. And that's why we've also set up the SME Power Up Fund, as well as a Sustainability Power Up Fund to fuel future growth. So the appetite to continue to support our customers is there, barring the fact that currently, in the market, loans demand remains quite subdued, but we are already getting our infrastructure in place to fuel the growth and to support customers going forward. I hope that answers your question. Anything else?
Oh, here's the end of our analyst session today. Thank you, everyone, for joining.
Thank you.
Thank you very much.